This CNBC story. As stocks have become mighty volatile, long-term investors could be induced to become more short-term oriented in their thinking, buying stocks on a single day's rally or selling after a swift 11% decline, such as we saw last week. Based on the historical performance of the S&P 500, it's that second decision, the fear-based move to sell, that is the more dangerous one. Let me try that again, so make sure you hear that. Based on the historical performance of the S&P 500, it's the second decision, the fear-based move to sell, that is the more dangerous one. In fact, even if one was the world's worst market timer over the past several decades, one still made money on stocks, according to an analysis done by institutional portfolio manager and financial writer Ben Carlson. He names his awful, or perhaps unlucky investor, Bob. Hypothetically, Bob made his first investment in the beginning of 1973, right before a 48% crash of the market, the S&P 500. He bought as high as he could buy. It dropped almost in half. This is me summarizing. Bob then held on to the stocks after the drop, saving a total of $46,000 and not getting up the gumption to commit any more savings until again he bought in September of 1987, right before a 34% crash. Bob then continued to hold tight, making only 2 more investments before retirement, which came right before the 2000 crash and then the 2007 crash. So how did Bob do with our hypothetical investment after these 42 years of epic market misfortune? He bought right before the 4 largest drops in the market, the 4 worst times since 1970 to buy. Now I'm summarizing, okay? So how'd he do? Well, he made money. Matter of fact, he made a lot of money. As the market successfully made record highs, Bob turned the $184,000 that he invested on those 4 events, just at those 4 events, $6,000 in 1973, $46,000 in 1987, $68,000 in 2000, and $64,000 in 2007. $184,000 turned into $1,160,000 for a total profit of $980,000. That represents an annualized return of roughly 9% on a money-weighted basis. Even after accounting for inflation, Bob has increased his wealth substantially by investing in stocks and never selling. The key is that Bob never, ever sold his holdings. Instead of riding the stock market's long-term trend higher, instead, he rode the trend higher. This hypothetical analysis reveals that it is critical to really understand your time horizon and that you need to think long-term. If one's investing horizon is several decades long, then the stock market has proven to be an extremely good bet, provided one didn't attempt to be smart by jumping out when one believes downside is ahead. What would be interesting to do as an overlay, folks, of this particular article and this piece of data, let me recap. Our hypothetical investor, Bob, put in $184,000 at 4 different times, a total of $184,000 at 4 different times. He invested the day before at the highest point, the 4 worst crashes since 1970. And the $184,000 turned into $1,160,000. So he made about $1 million. But he never sold. I mean, think if you had bought on September the 10th before 9/11. By the way, that wasn't one of the worst crashes on the day the market opened back up after 9/11. Think about that. What if you bought that day? How freaked out would you be? You bought at a high, and the market dropped substantially. But it didn't drop. I mean, it didn't drop as far as these 4. This guy doing this analysis picked the worst 4 possible downturns, and you invest the day before that. If you don't pull out, you don't get hurt. Those that don't jump off a roller coaster don't get hurt, and they get the thrill of the ride. So I guess the market's down again today. It could be up again today. I don't know which it is. You know, I don't think I care. And I'd like to do an overlay of all the end-of-the-world predictions that go with these. People trying to get you to do stupid butt things like take all your money out and put it in gold. Then you would see the real stupidity of this over an extreme period of time.